This is the Definitely Uncertain podcast. Each week, we look at how high net worth families can improve their lives, decisions and investments in a deeply uncertain world. We always aim to provide practical information, even if we can't offer specific investment advice.
Today, we will be looking at the energy investment universe. My name is David Ram, and I'm a partner at Goldrock Capital, the 20-year-old multifamily office servicing high net worth investors around the globe. With me is Zac Mccaroll, who is a partner at Private Advisors, a $5 billion alternative asset management firm headquartered in Virginia. Zac, who is based in Austin, Texas, oversees all aspects of Private Advisors' real assets activities. Zac has been involved in energy virtually his whole career and definitely is an expert on the topic. Welcome, Zac. Uncertainty is definitely a word we're going to be hearing a lot about, I assume, or maybe overusing over the next few months. And one of those areas is actually in the energy space where you're quite familiar, of course. Just kicking things off, I wanted to speak to you about the oil market a little bit, obviously, due to the fact that there's been a big falling off a cliff almost in pricing. It got quite exciting one day where there was negative numbers in terms of the futures market, and a lot of investors were thinking about how to be able to take advantage of such situations where oil prices seem to be so low historically. I just want to get your perspective on that.
There's a lot embedded in that. And so I'll first maybe just touch on the oil markets themselves. And I think one of the critical things to do is distinguish what's important and what is noise. And so we'll touch that, and then maybe we'll pause and I'll transition back to how to think about the opportunity, how to position that. So look, every day since about mid-February has been an interesting morning to wake up for me as we look at global headlines and what that means for crude oil globally. It is, we've truly seen generational headlines. We've seen events that haven't occurred in over, really in the history of the industry. And so I think there are really a number of things to look at. Number one, when we think about supply and demand, overall global demand is roughly 100 million barrels a day, or it was going in pre-COVID. And the demand for oil globally had consistently grown by about 1 to 2 million barrels a year annually for almost 2 decades. So this is an industry that's not going away, and there's high demand because the ultimate refined products, whether or not it's plastics, petrochemicals, jet fuel, gasoline, are in high demand globally as the global economy grows. What's unique about this is that a lot of the original headlines started because of the supply shock by OPEC Plus and the decisions from the Saudis and Russia not to cut production.
Right.
In my opinion, that's all noise. That is something that consistently happens on a cyclical basis. We saw the same thing in 2014-15. We saw a rapid response from U.S. shale, and U.S. shale technically won that price war as we move forward. So the supply discussion, in my opinion, is immaterial as it relates to the demand destruction that has occurred. So the demand destruction, again, when we look at experts and we go back to March, the beginning of March, everyone missed the allocation or missed the extent of the impact of demand. If you go back and look at research reports, it started with 1 to 2 million barrels a day off. 48 hours later, it was 3 to 5 million barrels. A week later, it was 10 million. And now what we're seeing is 25 to 30 million barrels, or 30% of global demand that has gone away.
For the year, for a 12-month period? Or
yes.
Okay.
So we think we'll see a recovery, but we're seeing a massive decline immediately globally. What people have to remember about the oil market is it is still a physical market.
Right.
It's not financially settled like equity markets. And so when you have a demand shock, the way that we've seen it, you then see inventory building over time in different locations.
On ships in the middle of the ocean.
That's right. So let's talk about that. Even when the Saudis and the Russians came back and they agreed to cut almost 10 million barrels, and we've also seen the Saudis in this last week cut additional production, it still does not compare to where we need to go to balance supply and demand.
So Zach, thinking about the point you just made around permanent demand destruction in the energy universe, as an investor in energy, how do you navigate the investment opportunities? Because obviously there has to be an equilibrium at some point of supply and demand. So how do you see that on a high level, supply answering the demand, even if there will be, as you called it, potentially a permanent demand destruction? And how do you expect that to look like in the foreseeable future?
In permanent demand destruction, what happens with aviation? Let's assume that we can all go back to work tomorrow. Under that scenario, how do we get back into balance, right? And let's assume that we have 80 million barrels. Let's assume that we have a 20% decline in oil demand globally. So we go from 100 million barrels to 80 million barrels. How do we balance that? So the quick version is we've already had 10 million barrels in cuts from the Saudis and OPEC. So now you're at 90 million of supply. The U.S. has responded 2.5 times faster than they did in 2015 around cost controls, shut-ins, and reducing capital expenditures. So the U.S. likely will roll off another 2 to 3 million barrels of production, and then the lack of continued investment will have a further effect as we get further in this. So now you remove another 2 to 3 million barrels of supply. Iran, Venezuela, and a number of other countries just are broken systems as it comes to operating in today's environment.
Yeah.
And so you can assume another 1 to 2 million barrels there. And then the natural decline curve for global production is 4 to 5 million barrels a year. So that gets you back into demand, supply and demand balance at 80 million barrels within a relatively short period of time. But in order to get there, it still takes 12 to 24 months. And over that period of time, the liquidity and the problems that will persist, I think, are going to cause restructuring in the industry.
Right. But the price, at the same time, the price of oil should, in fact, rise toward a $50, $60, $70 range in order to enable countries like Saudi Arabia and others to be solvent.
To incentivize investment.
Sure.
Right? So that comes to the question of permanent demand destruction, right? Is air travel really going to be cut in half forever?
Right. But in terms of other hydrocarbon sources, natural gas and others, I look at the equity markets, even in the private markets, and I look at investor demand. Clients of mine, like in the high net worth community, we are looking in this uncertain world and trying to figure out, okay, where do I place my capital? And looking at the energy space, I don't want to go to the hydrocarbon-based energy market because that's in secular decline. And in secular decline markets like retail or other markets that are in complete secular decline, you don't want to be a part of that process. You don't want to catch a falling knife. But I don't understand how that's possible. Looking at the math, from your perspective, if you want, how you're playing your own portfolio in the private markets as well, in terms of, okay, there's renewables opportunities, or alternative opportunities, there's hydrocarbon-based opportunities, and I want to ensure that you as an investor as well are taking part of that whole portfolio.
So number one, just to get the bias out, I clearly bet my career on energy. So let's just understand that.
That's fair.
Number two, and by the way, I don't think the global economy works without it, right? I don't think telecommunications, I don't think the high-tech world, I don't think healthcare, none of it works without stable, reliable deployment and availability of energy.
Absolutely.
So now, whether or not our policymakers agree with that, that's a different decision. But the world does not function without it. So one other bias. So, I mentioned this earlier, but I think that because of the cyclicality and the volatility within this sector, conservative capital structures and control are paramount. So, this, but in our private equity portfolio, we're over 80% equity capitalized, and we have over 80% kind of control-oriented positions. And you need that so that you can optimize the development of an asset. Okay, so those are my biases for the people on the phone who are on this conference who don't know me personally.
Yeah.
As far as opportunities today, I'll just describe a couple of things that we're looking at to kind of give a sense of what that risk return looks like. we are looking at the acquisition of cash flowing assets whereby we get returns based on dividend distributions. So acquiring natural gas and or oil related minerals or production at high present value discounts to their cash flow, paying equity only to acquire it, and then looking at hedging out production for certainty of recovery. We believe that we hold a lot of embedded options for, return to higher price environment, the ability to spend more capital for enhanced drilling and or volumes. And so those are the types of opportunities on the upstream side that we would be looking at today. We're being really patient in how we think about deploying capital over the next 6 months, but it will look like structured opportunities where I would say we're buying cash flow, whether or not that's through minerals or through it's through production. I am more concerned around the service space today, because when you think about
in service, just so we understand, service means what? It means companies that are providing
service. So who's providing the nuts and bolts, the picks and shovels, the drill pipe, all of those things to the industry? When you think about cost control, it first starts with you shut down capital expenses, right? And that's the drilling program going forward. So if you were a service company that provided parts and labor, you've got no market right now. And so there's an oversupply, which means costs are going to come down.
Right.
The next pivot will be on operating budgets. How do we control costs for our existing production? And you'll see headwinds there. So unless you have a proprietary product or you offer a cost benefit to the operator, you're going to be challenged.
Right.
So we're a little more cautious as it relates to service right now, but we think that there's going to be a tremendous opportunity kind of as we move through this cycle.
Interesting.
And then on the midstream side, I would say,
midstream again is the distribution guys, the guys who distribute from the drillers to the.
Right. I believe that there's been a non-fundamental reason why capital has moved into the MLP space, and that's because all institutional investors were looking for yield and they couldn't get it in the fixed income markets.
Right.
If I looked at a midstream asset today, I see headwinds. And the reason I see headwinds is they need to make distributions, which means they need volumes to flow through their systems.
Right.
If we're shutting down CapEx, if we're shutting down volumes, all of a sudden there's less activity for their system. And in addition to that, you've got potential financial stress for their long-term contracts on the upstream side as we work through a restructuring of the U.S. onshore shale industry. So the perceived creditworthiness of their contracts has the potential to be impaired as we move through this cycle. So, to put it in more traditional equity parlance, I think you're going to see a diversion of returns and more a kind of stock pickers type market as opposed to just buy the sector.
Now that makes a lot of sense, I guess, because of the nature of the leverage that is often embedded in a lot of companies in the energy space. So if you identify less levered companies that are still managing to generate cash flow, that seems to be the area in the short term and maybe longer term, looking out to bigger opportunities maybe in the services industry. That's really interesting. Zac, this has been great. It's always good catching up with you. I really appreciate your time. I hope you and your family stay safe and healthy. And I wish you and your team and everybody else much success.
Yeah, listen, thanks, David.
If you have any questions, comments, or ideas for future episodes, we'd love to hear from you. So please email us at podcast@goldrockcap.com.